everybody. This is John Lodrum, a co-founder and partner here at New Harbor Financial Group. Thank you for joining me for this weekly video. I want to make a quick announcement. We just launched a new written newsletter. So much of today's media is either podcasts or videos like this, and we got a lot of feedback from our clients and friends that sometimes they like to read something. So we have started publishing a monthly newsletter, our very first seminal issue, and we're going to be putting that out every month. There's a link in our bio where you can subscribe to that newsletter. It'll come via email, but also through Substack, which is a free platform that we can publish this newsletter. And it will unify the big picture themes that we see throughout the month. Feel free to subscribe to that and value your feedback at any time. So let us have it. Today's video, I want to talk about behaviors as it relates to investing. Untold hours are spent by investors of all stripes, Wall Street analysts, we here at New Harbor, even do-it-yourselfer investments to try to make sense of the financial markets and economy. Of course, the ultimate goal is to inform a logical investment strategy to grow one's financial assets. People clearly don't want to go backwards when it comes to investing. They want to go upward and onward. In fact, most of the approaches prescribed by Wall Street and financial advisory firms, our peers, are grounded in kind of academic theories, things like the so-called efficient markets theory. Efficient market theory is an intellectually pleasing theory. There are times where it is completely and utterly at odds with what's actually going on in financial markets. In fact, I did a whole video essentially debunking the efficient market theory, and there's some great quotes and wisdom from folks like Warren Buffett and Charlie Munger in that video. So have a look at that video when you have some free time. It might be helpful to follow up to this video for you. So while our brains thirst for markets to make sense, the reality is that there are times, especially over the very short term, where they're driven by human biases, fears, and emotions. And we're all human, even we here that are, so-called investment professionals. And markets just become utterly illogical and irrational. So I'd like to start this video by sharing some, I think, impactful quotes that speak to this from some famous investing legends. The investor's chief problem and even his worst enemy is likely to be himself. Tim Maurer gives a great one here. Personal finance is more personal than it is finance. Jason Zweig, awesome quote here. Investing isn't about beating others at their game. It's about controlling yourself at your own game. Yeah, we're really battling ourselves oftentimes more than we are markets. And here's a very famous quote from none other than Warren Buffett. Be fearful when others are greedy, and greedy when others are fearful. That really speaks to the idea that our emotions and psychology can be our worst enemies. Being aware of those biases and those emotions are the key first step in overcoming them. With that backdrop, and certainly this year in 2025, so if there ever has been a recent year that has been very much driven by emotions and headlines and news and this and that, this is a perfect case study. I'm going to cover 5 common biases in behavior. And at the end of the video, so stick around, I want to talk about what we can do as humans to help control and put those biases that otherwise can be destructive and unhelpful into check and become better financial stewards and investors. First bias is what is called confirmation bias. Simply confirmation bias, maybe a quote from Mark Twain will put this into context. It simply goes, "It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so." Great quote. This is at the heart of confirmation bias. We all have biases. We generally go out of our way to find news or information that supports our own strongly held beliefs, while we oftentimes will avoid, either subconsciously or outright consciously, information or data that contradicts that belief. Perhaps in investing, many people oftentimes ascribe certain outcomes to what political party is in office as relates to markets. And we have some pretty interesting data we can look at that really kind of oftentimes will refute those. Let's talk about Trump, for example, both in his first term and here Trump 2.0 has talked very supportingly of traditional energy, fossil fuel energy. The slogan, drill baby drill, right? People would be forgiven to believe that under that kind of platform that traditional oil and gas companies would be great performing investments and that renewable energies, solar, wind, and things like that would lag. But in actuality, if we look at the last couple of administrations, renewable energy stocks as a class, broad class, did tremendously well under Trump 1.0, Trump's first term. And they did very poorly under Biden's administration. And the complete opposite was the case. Traditional energy companies didn't do so well under Trump 1.1, and they did quite well under the Biden administration. So this is a study that goes back from 1990 through 2023, and it shows for the S&P 500 right here on the left hand, and then the various economic sectors, the performance during Republican administrations versus Democratic. Now, the diamonds are the average, and the bars here represent the extremes. Let's talk about energy, as we just talked about. You can see on average, energy stocks have done better under a Democratic, this blue bar, than the red bar. Now, that contradicts many people's strong-held beliefs. And even the worst case scenario was worse under a Republican administration as compared to Democratic. And you can see across all these various sectors, I'm not going to go through each one, but even as the market as a whole, many people think that just because Republican administrations tend to be more business friendly, relaxing regulations and things like that, that markets are destined to do better under Republican administrations. When in fact, at least over this time frame, on average, they've done better under Democratic administrations. Now, I want to clear up that there's factors beyond politics here that drive that. The point is that the strong-held beliefs about certain political administrations and what it means for markets are oftentimes subject to our own confirmation bias, and that's just not helpful. Let's go on to the second bias. And this one I want to talk about is referred to as recency or extrapolation bias. This basically says, hey, we tend to extrapolate recent events and trends as if they'll continue indefinitely. So when markets are going up, we think they're always going to go up. And when they're going down, we think they're always going to go down to zero sometimes. And it's just we humans have a tendency to do that. It oftentimes comes down to people looking in the rearview mirror in terms of investment returns and assuming that rearview mirror will also be what the windshield ahead looks like. That's just not the case in actuality. So this graphic gets to the point of this. It goes back from the end of 2007 through the end of 2024. And it shows from highest to lowest. So at the top of each column is the best returning stock style, if you will, ranked from best to worst. In 2024, growth stocks, U.S. large cap growth stocks did the best. And what did the worst? Boring old dividend stocks, right? You can see how this changes. You can just look at the tiles here and you can see the colors flip-flop almost perfectly every year. There's very few times where stock selection factor continues year after year to be the right one. In fact, if we look at just year to date so far in 2025, growth stocks have gotten hammered, especially U.S. growth stocks. And things like low volatility and quality and value have started to do better. Dividend stocks have started to do better. Case in point, the recency bias can oftentimes lead you to pick the wrong areas of the market. The third bias that I want to talk about is what is referred to by academics as regret, aversion, and hurting bias. These are two different things, but they're very much related in my opinion. So basically, regret aversion bias is we humans fear loss, or missing out for that matter, more than we enjoy gains. It's just we're hardwired. Maybe we don't know this about ourselves, but it's time and time again been proven in psychological studies. So people with this kind of bias, they'll avoid making investment decisions out of fear they'll be wrong or that they'll turn out poorly. Or another variant of this is that they'll make decisions that cause them to miss out when others, their friends and family, neighbors are celebrating gains. This aspect oftentimes fuels hurting behavior, basically where investors will gravitate towards popular investments because there's perceived safety in numbers. If I lose, well, at least everybody else is losing with me and I won't feel so bad. There's countless examples of this, but perhaps maybe the most famous one is a story about Sir Isaac Newton. So there was a bubble in the 1700s called the South Sea stock bubble. Here's a graphic that speaks to the experiential witness of that bubble by none other than Sir Isaac Newton himself. Unarguably a genius, right? A brilliant mind. This basically is a simple chronology of what his experience was. He invested a little bit in South Sea. He exited here higher. The stock rose quite dramatically. He sold here, but his friends kept on partying. The friends kept on seeing vertical ascent in the stock. And even Sir Isaac Newton couldn't resist the urge to get back in. He not only re-entered, but re-entered with a much larger position than he initially had. And then, of course, the bubble broke and Newton, as well as everybody else, got left holding the bag. Newton's quote, I think, says it all. He says, "I can calculate the motion of heavenly bodies but not the madness of people. Awesome quote. Truly, biases and emotions can sometimes manifest in what can be described by nothing other than a madness. And other examples of that in financial market history are easy to point to. The tech bubble of the 2000s, internet stocks, dot-com stocks could do no wrong. The housing bubble of 08, 09, the belief that housing prices would continue going up and they wouldn't ever drop, and certainly wouldn't drop on a nationwide basis. Well, that obviously happened, and we know that. Who knows? We think we're in the midst of a massive stock market bubble right now, and maybe even acute bubbles in things like AI, artificial intelligence, and things like that. These are oftentimes the result of these very guttural desires to avoid missing out, making a mistake, and hurting into other investments with everybody else. The fourth bias I want to talk about is overconfidence bias. And overconfidence bias can obviously come at great cost in so many ways. But a couple of common ways we see that in investing is people will take a larger position size in a stock or an investment because they're so sure it's going to be a good thing. They may subject their portfolio to very over-concentrated risks in certain positions. There are obviously examples that we can point to in Mag 7 stocks. Over the last several years, these stocks have gone up. They've run into quite a soft patch here, generally speaking, here in year-to-date 2025. But we've seen some people have started as modest positions become very, very large, overwhelmingly large parts of their overall portfolio. And this oftentimes can be pointed to being overconfident in the prospects of a stock. And then it also can cause folks to double down on losers if they're so confident and the stock, despite their confidence, drops in value. Being overconfident can cause them to say, you know what, I'm going to buy even more. And that can get folks into a bunch of trouble. So the fifth and final bias I want to talk about is endowment/attachment bias. This basically is the simple notion that we are oftentimes reluctant to sell investments we already own. They're either up and hey, we think they're going to keep going up, or they're down and we can't possibly sell now and book a loss because it's going to come back. So it's oftentimes based upon performance or lack thereof that keeps one in their existing investments. And one of the costs of this is it leads to myopic thinking, but also causes a failure to consider other investments that may have better prospects, the so-called opportunity cost. Let's face it, most investments are just simply very liquid things you can trade in and out of, and you should never, ever fall in love with an investment. You should always try to be unemotional about it and think about it as your servant, not the other way around, your servant in achieving financial stability and security. We oftentimes also see this when folks maybe come into an investment either due to current or past employment. Folks oftentimes will have very large concentrations in the companies they either work for presently or worked for in the past, and they just feel like they know so much about it, and they have almost like this allegiance to the stock because they had a fond experience working for the company. But we also see it when folks inherit assets. They may have inherited money from a parent or grandparent. They almost hold that investment as a tribute to that deceased donor. The sentiment is certainly understandable, but can actually be quite damaging to your financial stability and investment performance. So those are the main biases that I want to talk about. Again, there's so many. We're complicated humans. Even we here at New Harbor work really hard to control our bias. In the comments, please share any that I didn't cover that you're aware of. Key is how do we help guard against these? Well, the first is becoming aware and becoming mindfully aware of how these things can control our decision making. We certainly work really hard to be mindful of these biases in the work we do for clients here at New Harbor. But beyond that, it's really important to have a systematic, disciplined, preferably data-driven approach where it's black and white data that you can look at and observe. We use a whole bunch of tools here at New Harbor in guiding our investment process. Certainly things like valuations from a big picture standpoint are very helpful, objective lenses through which we kind of look at markets and opportunities or lack thereof. But in the shorter term, things like technical analysis, relative strength, momentum, these are all data-driven things that actually are a data expression of the behaviors of people. And just because there's a momentum, it doesn't mean it's a healthy momentum, but it's momentum nonetheless. And we have to respect that in terms of how we invest or restrain from investing on behalf of clients. Take a look at your own process. Challenge yourself to be driven more by data rather than feelings or emotions. Certainly happy to talk with anybody. Clients, of course, know they can call us anytime, but anybody seen this video? We've got over 4,000 subscribers. We thank you all for subscribing and following us. Feel free to share it with folks that you think might be helpful. Our purpose is really here to educate through data and insight. Subscribe to our channel. You'll get alerted anytime we put content out. Happy to talk with anybody that may be seeing this video that would like to have an objective conversation about their financial picture and how it can be revisited in a way to put some of these biases in checks. So thank you so much for watching. Until next time, I want to wish you a great day.